The numbers are hitting. Let's get over to Rick Santelli and see what he thinks about that data. Rick, good morning.
Yes, good morning, Becky and Steve. April preliminary read on durable goods. It's a very volatile data series, and the preliminary, of course, will change in a couple of weeks. Minus 6.3% is our preliminary look. That's a little bit lighter than the minus 7.8 to 8.2% that was somewhat built in. And in the rearview mirror, we still have very powerful numbers. 9.2 is revised to 7.5, which is now revised to 7.6. And these are the best numbers since, COVID-related 2020 era. So it really is somewhat incredible. But, of course, much of this has been due to transportation, aircraft. Right now, if you take out transportation, you can see that minus 6.3 does improve to up 0.2. So we see that once again, it is a positive force with respect to the durable goods number, which was negative. And it does balance out against that 7.6. So we've had a couple of powerful months. Now we're giving a little bit back. Ex-transportation, pretty good. Now let's look at orders. These are capital good orders, non-defense ex-aircraft. Proxy for capital spending taking a ding here. This is somewhat unexpected. Minus 1.3%. We're expecting a number that was, minus 0.2%. And in the rearview mirror, we gain a couple of tenths from 1/10 to positive 3 tenths. But minus 1.3 would be the lightest since September of 22. If we reverse now from orders to shipments, down 0.1%, pretty much as expected. A big boost to shipments in the rearview mirror. And that really shouldn't be surprising to anybody keeping up with all the tariff issues going on. But up 0.2 doubles to up 0.5, up 0.5% in the rearview mirror. That follows up 0.6 in February. So a couple of big shipment orders. We do see that interest rates are a bit lower. Long end is lower. And as Steve pointed out, maybe some of that, of course, is based on global supply issues with Japan. But, boy, Japan really starts to get complicated with all the different things they've done to try to squash interest rates. And it shouldn't come as any surprise that they're now having problems, issues trying to control the rise in interest rates. We do have some supply this week. We'll continue to monitor to give us an idea. It was really kind of crazy last week that a 20-year bond auction, that kind of funky part of the yield curve, caused so much agita, which just goes to prove that supply is something that many more are paying attention to in 2025. Back to you.
Well, Rick, I'll ask you about that. With the reaction we're seeing not only in Japanese yields coming down, but also in U.S. yields kind of following suit with that. That's based on the idea that Japan might intervene and not sell as many on the long end. But this is also ahead of a 40-year bond sale for them tomorrow. So kind of important that they got rates a little more under control before they rolled that out. Do you think this lasts, this sort of renewed optimism that the Japan and others may not have to issue as much on the long end?
Yeah, I think the optimism in Japan might not be as well grounded as many believe. I continue to think there's going to be big issues there. And those issues will affect all global sovereigns because, there is only, one global set of buyers that are now going to have to kind of split their capital in a number of areas. But I do think that the U.S. is going to continue to shine, even with our ugly debt and deficit and the idea we can't stay on this path. We're still in many ways a little bit better issuer in terms of quality and credit, in my opinion. Japan's going to have lots and lots of issues. And I'll also say that I think we would have been under 5% no matter what Japan did. Much of the pop in interest rates was overblown last week.